Hello everybody. Thank you for this great and wonderful conference. As the title of the paper here suggests, we examine the valuation practices of hedge fund advisors by looking at how these hedge fund advisors mark their equity positions for reporting purposes. To motivate the analysis, I'll start by saying that the valuation practices of hedge fund advisors in the recent years have come under intense scrutiny from regulators and the business press. There are two issues here at the heart of the matter. On one hand, several hedge fund advisors have been caught engaging in egregious forms of manipulations of their asset valuations. On the other hand, the valuation discretion enjoyed by these hedge fund advisors when they value illiquid securities gives them a certain amount of protection against potential litigation, which is also something that they can use to manipulate these asset valuations. Why do we care? Well, these irregularities in the valuation practices of hedge fund advisors could have welfare implications for investors by causing welfare transfers across existing, new, and redeeming hedge fund investors. Furthermore, the manipulation that is intended to smooth reported returns could distort the risk-return profiles of some of these hedge funds, causing investors to make suboptimal investment decisions. Now, echoing these concerns from the regulators, there have been several academic studies that look at the returns that hedge fund advisors report to commercial databases. And they document three patterns that are consistent with intentional manipulation with these reported returns. The first pattern suggests that hedge fund advisors are smoothing their reported returns. The second pattern is consistent with hedge fund advisors manipulating their returns upward towards the end of the calendar year. The third pattern is consistent with hedge fund advisors trying to avoid reporting small negative returns at any cost by causing a discontinuity in the reported returns around zero, whereby the number of small positive returns far outweighs the number of small negative returns. All right, so this is what has been shown with reported returns. All right, now, although these patterns that we have seen are consistent with intentional manipulation, they could also arise due to issues that come about when you value liquid securities that are of a mechanical nature. So, for example, suppose that you have a hedge fund advisor that is trying to value illiquid securities using stale prices. Okay, this practice could give rise to autocorrelated as smoother reported returns, which is one of the patterns that we have seen. Also, consider a hedge fund advisor that is trying to value some securities that did not trade at all during the day. And the advisor is going to do this using evaluated prices that fall within a legally allowed pricing range. Now, in this case, the hedge fund advisor could use this discretion to push what might have otherwise been small negative returns above zero, giving rise to this discontinuity in report returns that we have seen before. All right, so having said that, the main contribution of our paper here is that unlike these previous studies that rely on indirect evidence from these reported returns, in this paper we provide direct evidence on the evaluation of these security positions by hedge fund advisors for reporting purposes. And doing so, we provide direct evidence that is consistent with manipulation by showing mismarking even among equity securities for which market prices were readily available. In other words, by showing mismarking even for those positions where the hedge fund advisors should not have used evaluation discretion. In addition, we show that this mispricing or mismarking that we document appears to be related to hedge fund incentives. In particular, we show that mismarking is particularly strong when hedge fund advisors have strong incentives and when the probability of getting caught is low. Extending our analysis further, we also show that there is a relationship between this equity mismarking that we document, this mismarking among the equity positions of these hedge fund advisors, and some of the previously documented patterns with reported returns that might be indicative of manipulation. So we show that hedge fund advisors with more mispricing show a stronger discontinuity in reported returns around zero, and they also seem to report smoother reported returns. All right. So I'll go straight to the data here, and the position valuations data that we use for this study comes from 13F reports that hedge fund advisors filed with the SEC. The reporting requirements are such that if you are an advisor that manages more than $100 million in assets in a list of pre-specified equity securities, then you are required to report your holdings on a quarterly basis. The nice thing about these 13F filings is that for each position, equity position, they report the number of shares held, and also they report the fair market value of each position, which is basically the valuation that an advisor places on this particular position. We have position valuations data on 885 hedge fund advisors. The position valuations data is supplemented with characteristics on hedge funds and advisors from CISDM and also with crisp stock prices. Here I have an example of how you use 13F files to construct an implied price that hedge fund advisors, in this case, use to value a particular position. So we have a hedge fund advisor that at a particular point in time was holding 3,000 shares in the common stock of 3M. The advisor placed a valuation of $229,000 on this position. So in this case, the implied price is going to be $76.33. Okay, so this is the approach that we use to infer implied prices. Next, once we have an implied price for each position, we take this implied price and we compare it against the crisp reported price, okay, for the same security on the same date. And in effect, we calculate a measure, a measure of mismarking, which is a percentage deviation of the implied price from the market price, which comes from the crisp database. In this table, we report the frequency of mismarked positions. So we have about 2.3 million positions that we are looking at. These are common stock positions. And out of these positions, using our mismarking measure, we have roughly 7% of the positions that are mismarked. In other words, we have roughly 155,000 positions that are valued at prices that are different from the crisp prices. To get an idea of, of the economic magnitude of this mismarking among these 155,000 positions, we calculate the average of the absolute value of the mismarking measure, and we come up with 3.20%. Okay? Now, this mismarking is not extreme by any means, but it's not trivial at the same time. Okay? Now, a natural question to ask is, what is causing these 155,000 positions to be mismarked? What could be going on here? Well, one possibility is that these positions correspond to illiquid stocks for which hedge fund advisors are using some kind of valuation discretion to price these positions. It could be that these positions correspond to stocks that did not trade on the last day of the quarter, or they correspond to stocks that traded very thinly during the last day of the quarter. For example, if you have an advisor that is trying to value a stock that had only one trade at 10 a.m. in the morning and no trades thereafter, well, this advisor might basically ignore the 10 a.m. price as a stale price and come up with a user evaluated price to value this particular position. So you could have this. So to control for this, illiquidity-induced, issues here that could be related to mispricing using our measure, we try a couple of things. The first thing that we do is we stratify the positions into those corresponding to stocks that traded on the last day of the quarter versus those that didn't trade on the last day of the quarter, which is the day of the reporting. And what we find here is that, well, first of all, the number of positions that correspond to those stocks that did not trade on the last day of the quarter is rather small. Okay. Furthermore, what we see is that the mismarking among the remaining positions for those stocks that traded on the last day of the quarter continues to be, of a significant magnitude, economically significant magnitude, still at 3.26%. So the other thing that we do here is we take these positions that correspond to stocks that traded on the last day of the quarter, and we stratify them by the illiquidity of the underlying stocks in these positions using the Amihood illiquidity ratio. And what we see here is that if you look at even among the most liquid decile, you still continue to see, okay, this amount of mismarking which continues to be economically significant, still 3.11%. So, mismarking does not seem to be the simple byproduct of illiquidity in this setting. The other thing that we do here, since we're talking about these mismarking measures, is that we look at how widespread this mismarking is across all the advisors that we're looking at. So we calculate mismarking measures at the advisor level, then we look at cross-sectional statistics, and what we see here is that although it is not widely spread, about 25% of the advisors show an economically significant amount of mismarking. All right, now, so I mean it could still be that the mismarking that we document is due to some kind of a random process. For example, it could be related to data entry errors. It could be related to some institutional details that we are not aware of. And for the data entry errors, we tried all kinds of things, to correct for those. We have a extensive appendix that describes the procedures, the steps that we took to clean the errors. But let's say that this mismarking is due to some kind of a random process, due to this some institutional details that we are not aware of. Well, then mismarking should not be related to hedge fund incentives. Okay, so what we do next is we examine whether this mismarking that we document among these equity positions of these hedge fund advisors is related to hedge fund incentives to mismark. What we do is, the first thing that we do here is we look at, so one possibility, one way in which hedge fund advisors, one reason they might want to mismark is to smooth reported returns, is to smooth their returns, right? And the idea is that the mismarking then would be a function of past performance. And the idea here is that, following a poor quarter, following poor returns, an advisor might want to mark up the positions, and following a good, return, a good, quarter or 12 months, he might want to, mark down. So what we do here is we examine this possibility, and the dependent variable that I show here, we use two versions, is the net portfolio mismarking. The net portfolio mismarking is the signed dollar amount of total mismarking that we observe for each of these 13F advisors every quarter, divided, normalized by the sum of all the positions valued using CRIS prices. The independent variable is in this case, is the last quarter return. So this is a holding-based measure of return for the 13F part of the portfolio that we observe. And we use also other versions where we look at the year-to-date return and the past 12-month return. To control for the illiquidity of the stocks that we observe in the 13F part of the portfolio, we include the average Amihood illiquidity ratio is the control variable here. And so what we see here is we see a negative relation from this regression between the last quarter return and net portfolio mismarking. So this suggests that following a quarter of poor returns, an advisor tends to mark up their equity positions, and they do the opposite following a quarter of good returns. This is consistent with return smoothing. Here we do a couple of other tests, and it looks like I don't think I'll have time to go through all of them, so I will basically describe the results here. The next thing that we did was we examined whether there is a relationship between this mismarking that we document and the probability of getting caught. And to do that, we basically examine the relationship. We try to measure some form of general mismarking here, not necessarily directional mismarking. And what we find here is that advisors that manage funds that are domiciled in offshore locations, or they manage funds that are not audited regularly, they show more mismarking. The other thing that we do is we look at whether mismarking is something that advisors use as a tool when they try to promote their hedge funds to potential or current investors. And what we find here is that we find that advisors that self-report their hedge fund returns to a commercial database, in this case we use CISDM, they show more mismarking. Okay, and in a recent round of updating of the paper, we have included TAS and Morningstar here, and so basically what we show is that advisors that report to at least one hedge fund database they show more mismarking. And this seems to be, I mean, this is an important finding because it has implications for a lot of the studies that look at, performance of hedge funds using these self-reported returns in these commercial databases. The other thing that we show here is that advisors that report to their current investors at a higher frequency also show more mismarking. The idea here is that these advisors are probably trying to impress their current investors, and they try to report more to these guys. All right. So the next thing that I'm going to do is I'm going to look at whether there is a relationship between this mismarking that we document and some of the previously documented patterns with reported returns that might be indicative of manipulation. So the first thing that we do is we look at whether the mismarking that we document is related to this discontinuity in reported returns around 0 documented by Boland and Poole in their Journal of Finance 2009 paper. And the idea here is that what these guys find is that advisors try to avoid reporting the small negative returns, causing this discontinuity here, whereby the number of small positive returns exceeds the number of small negative returns. So we examine whether the hedge fund advisors that mismark more show a stronger discontinuity in their reported returns. To do this, we use, to capture the discontinuity in reported returns around 0 for each hedge fund, we use the kink measure developed by Boland and Poole in their working paper. And the kink measure, is shown to be one of the best predictors of hedge fund fraud. And the kink measure, what it is it indicates whether the discontinuity in reported returns that we observe for each hedge fund is statistically significant. So the dependent variable that we use here is the frequency of funds that are classified as kink funds for each advisor. Okay, so we look at each advisor, we look at the frequency of the funds managed by this advisor that are classified as kink funds. The main independent variables are dummy variables indicating whether these advisors fall in the high or the medium mismarking groups. We control for the liquidity of the stocks that we observe in the 30F part of the portfolio using the AMI-hooded liquidity ratio. We also try to control for the illiquidity of positions that we do not observe in the 30F report. And to do that, we use the average of the Pastor and Stambo illiquidity beta that we construct based on the reported returns for each hedge fund. Then we average across all the hedge funds that belong to the same advisor. All right, so what we see here is that from this regression, the advisors that exhibit more mismarking, they seem to manage a larger fraction of funds that could potentially be fraudulent. Another way to think about this is that these hedge fund advisors show a stronger discontinuity in their reported returns. And we see this both for the high and the medium mismarking groups. The last thing that we look at here is we examine whether there is a relationship between mismarking and return smoothing. To do this, we employ the framework of Getmansky et al., who model observable reported returns as a finite moving average of these economic returns that are the true economic returns that are unobservable. Basically the key variable here is this theta zero coefficient. Theta zero coefficient tells us what fraction of the true economic returns makes it to the reported return. A theta 0 less than 1 would suggest that reported returns moves on a less than 1-to-1 basis with the economic return, which is consistent with return smoothing. So what we do is we calculate a theta 0 coefficient for each of the hedge funds. Then we average the theta 0 coefficient across all the hedge funds that are managed by the same advisor. That gives us a theta 0 that is specific to each particular advisor. Then we include the same independent variables as in the previous specification. And what you see here is that the advisors that fall in the high mismarking group, they report smoother, they have lower theta 0, they report smoother report returns for their hedge funds. To conclude, I'll say that looking at these position valuations of equity securities that hedge fund advisors hold, we show mismarking even among those positions for which market prices were readily available, and even among those positions that were highly liquid. Although the majority of hedge fund advisors do not mismark, we still observe that 25% of them show a significant amount of mismarking. And this mismarking does not seem to be caused by manipulation. It appears to be related to incentives and some of these previously associated patterns with reported returns. Thank you.
All right, thank you very much. I definitely enjoyed this paper, so I appreciated the opportunity to come to the conference and discuss it. I will briefly give a summary and obviously then give my comments. But I would say broadly, this fits into the type of literature that is studying hedge funds by trying to look at public data. Public data generally falls into the self-reported returns to hedge fund databases or 13F data. And so they're going to exploit kind of a novel piece of information in the 13F data here. Okay, I think that it's a very sort of clear, concise paper. It's easy to summarize. So the overarching conclusion is that hedge funds manipulate the valuations of their individual positions. And the authors conclude by looking at only the most liquid securities that this must be intentional manipulation. Then they go on to look at what this mismarking is correlated with. And that falls into three broad areas. Looks to be negatively correlated with the hedge fund's own performance. When they look at mismarkings and tie them to incentives, I just have one of their results here, but as an example, mismarkings are negatively correlated with the probability of getting caught. Then they turn to finally looking at mismarkings and whether they affect returns. And again, I've highlighted one of their results here as an example. Mismarkings are associated with discontinuities and the hedge fund's returns around zero, and the hedge fund return distribution around zero. So let me go into my comments. The first one is a technical comment, and I think that the authors need to do a better balancing act here between the appendix that goes through all of the technical cuts they make and how much they discuss in the actual text. So they do discuss a little bit in the text, but it's not enough for the reader to really understand what's happening. So I want them to discuss this point more. It's confusing when you read it. They give a discussion about throwing out mismarks between 0 and 999.99 because you have the ability to round. And if you look at the 13F instructions, it says that you can round the position to the nearest 1,000. There needs to be more discussion of what's actually happening in there because when I read it, every position, no matter how large, can be round to the nearest 1,000. Okay, so I don't think that we can focus on just one area and discard those. Now, I'd like to learn a lot more about the equity patterns here, especially when we look at the conclusion of the paper. And I think the way the paper was presented today by saying that the results are consistent with manipulation is slightly less strong than it is in the paper. So if you read the paper, it looks to be a very strong conclusion about intentional manipulation. So I would just encourage the authors to make sure that they've exhausted all the alternatives. And for me personally, I would like to know more about possible patterns in the equities than I see in the paper right now. Obviously, they do a very nice job of looking at liquidity. Since this is an important part of the paper, I would like to see more robustness checks around the definition of liquidity. They may have to use some cruder measures, but it's such an important part of the paper that I think they need to do some robustness checks. Possible patterns to look at, pick your favorite stock characteristics, your firm characteristics, volatility, industry. Tell me a lot more about the types of securities that seem to be mismarked. I'd like to know a little bit about patterns on the fund side. So if you only look at the largest funds or the largest positions, what do we learn about mismarkings there? Again, if we're trying to look at whether the conclusion is intentional manipulation, I think we need to check a few more boxes. Is it possible that there's any sort of ex-dividend disparities, any sort of disparities across exchanges and in closing prices that could result in seeing these same results? When it comes to the databases, I'd also like to see more discussion in the paper. And in terms of the 13F reporting, that's at the conglomerate level for the entire entity. Does that have an effect on the paper? Normally, when papers are using 13F data, it's very important for them to, at least in some of the hedge fund papers, they try to look at only hedge funds that are singly reporting, so they're not part of a conglomerate. Does that matter here? Also, it took me and a couple of other people reading the description of the 13F data that they used to understand what was really happening here. In that, for those of you that you normally use the Thomson 13F database, Thomson puts in the price so that it's actually consistent across every firm's reporting. The nice part of this paper is that they actually were able to get database from words that had the hedge fund's own reported valuations. So that's what they're exploiting here, and it needs to be drawn out a little bit more in the paper so the reader understands. We already heard about this today. One of my suggestions was that the CISDM database, they only have about 30% of their 13F sample that they're covering by using that, and they've now used Lipper and Morningstar. So I think they're up to about 50% coverage now. I wanted to make a few comments related to policy. So I have a quote here from the authors that thus mandated disclosure alone might not be enough to protect the interests of investors and deterring asset manipulation by hedge funds. And so my own advice, I think that's an intriguing statement, is to either flesh that out and find out what's happening here or remove it from the paper. Because I don't think that there's really any study around this issue in terms of what's happening. We don't have a lot of public reporting, required reporting by hedge funds right now. So is it that more quantity or different information that's kind of related here? Is it that we need a different type of information to be disclosed? One way that you could look at that, there are a lot of 13F filers of different types. Mutual funds, pension funds, conglomerate financials, insurance companies. So if you look at other types of 13F filers, do you see mismarkings? If you don't, then what is it about the nature of hedge fund regulation versus, say, the nature of mutual fund regulation such that you see mismarkings in one place and you don't see it in the other? Also, 13F is a public forum. Hedge funds are supposed to be sophisticated investors. We can argue about whether they actually are or not, but they're supposed to be. So I'd like to see a discussion in the paper of what frictions are stopping them from disciplining this behavior. I think that's an important piece that we need to understand. I have some very minor comments here, but I think this first one, while it's minor, it's actually very important. So the leading example in the leading paragraph and that we heard today references Bernie Madoff, and he actually did not run a hedge fund. He was a managed account advisor. So you need to choose a different example for this paper. And given where I work, I'm not going to suggest the hedge fund that you should actually use, but go to the public articles and you'll have many to choose from, I'm sure. I would also rework the introduction. The way it reads right now, there's a lot of interesting results, and they actually discuss them twice. So they go through their results, then they go to the literature and discuss how their results tie in again. You don't need to do that twice. It's just confusing to the reader. And again, I also want to re-emphasize that in the paper, the conclusion is very strong on intentional manipulation. And from my reading, I don't think that we've exhausted all the alternatives yet. But I really enjoyed the paper, and anytime we can shed light on this area that we don't know much about, we've really learned something worthwhile. So thank you.